The DTCC is desperate for more money to pay for the squeeze. They're trying to drum up as much money as possible in any way possible, and it seems like they're even facilitating more manipulation to try and avoid the inevitable squeeze. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, Tom Zazzulo tweeted saying, breaking news. The SEC has just filed to say the Options Clearing Corporation is seeking to expand its cash reserves in order to manage a potential member default. Obviously, if one of these large institutions, one of these large market makers, or one of these major banks ends up defaulting in the coming market crash and during the coming AMC squeeze, the remaining members of the DTCC will be on the hook to pay for their liabilities. For example, if Citadel is liquidated during the coming AMC squeeze and they can't afford to buy back all of the shares they need to close out of their short positions, the remaining members of the DTCC are responsible for paying for this default. Now, while remaining members are responsible for paying for this default, the DTCC itself is trying to drum up additional sources of cash to help those remaining members pay for this individual defaulting member without bankrupting themselves. Obviously, if one of the major banks like JP Chase goes under, all of these remaining smaller banks will be responsible for paying for their liabilities and could end up bankrupting or liquidating themselves, trying to pay for JP blunder. And therefore, the Options Clearing Corporation and the DTCC are trying to drum up additional separate cash reserves away from the existing members' current cash reserves. And as Tom said, members like Citadel have apparently become way too over-leveraged by writing options and now potentially face a default during the coming AMC squeeze and during the coming market crash. Tom's screenshot says that agreements with banks and other counterparties, aka liquidity facilities, have been created to provide the OCC with cash in exchange for collateral such as US government securities. It says the OCC routinely considers potential market stress scenarios that could affect such payment obligations. Based on such considerations, the OCC now believes that it should seek to expand its liquidity facilities, aka drum up more cash, to increase the OCC's access to cash to manage a member default. And one of these additional liquidity facilities the OCC has been working on is free access to pension pots around the US, and the SEC has just greenlighted a $35 trillion pension pot for clearinghouse defaults. It says the SEC has removed a $1 billion cap on the amount of pension funds that can be tapped by the OCC or the Options Clearing Corporation in case one of its members defaults. This basically means that previously, in the past, if one of these major members like Citadel defaulted, the SEC and the OCC could effectively raid and steal $1 billion from your pension. But now they've actually just removed this $1 billion cap, therefore they have free reign to raid and to steal as much money as they possibly can from your pension pot, up to $35 trillion. It says, with respect to OCC's overall liquidity plan, the non-bank liquidity facility program reduces the concentration of OCC's counterparty exposure by diversifying its base of liquidity providers amongst banks and non-banks, non-clearing member institutional investors such as pension funds or insurance companies. Basically, the OCC now doesn't need to take money from other banks, and therefore it's not just other banks that are responsible for defaulting members' liabilities. They can now also take money from insurance funds and from pension plans as well to pay for this defaulting member. Clearly, the OCC and the DTCC are desperate for more money to pay for the AMC squeeze, up to the tune of $35 trillion. Now, we already knew that cumulative assets of all of the remaining DTCC members is somewhere around $60 trillion. Now, they can take and steal an additional $35 trillion, totaling somewhere around $90 to $100 trillion. While this is bad, the OCC and the DTCC now have free access to steal money from your pension. At least that means there's now $100 trillion to pay for the AMC squeeze. Now, many of you have asked if my AMC squeeze brackets have changed as a result of APE being issued and the price of AMC falling. If anything, this increases my brackets for the AMC squeeze as there's now more money to pay for the squeeze itself. But I think that's a separate video entirely where I'll explain my new updated brackets. But on top of that, it seems the DTCC and the SEC is even facilitating more manipulation to try and avoid the squeeze. Tom tweeted saying, breaking news, the Nasdaq is abolishing retail liquidity identifiers. That means that liquidity providers like Citadel no longer have to identify themselves when filing retail orders. The Nasdaq has blatantly admitted that this is to attract more business from liquidity providers, aka infinite liquidity fairies. It says the purpose of this rule change is to enhance the BX retail price improvement program in a manner that will attract more liquidity providers to participate in the program. Specifically, the exchange proposes to amend a paragraph to provide participants a choice whether to disseminate the retail liquidity identifier when submitting retail price improvement interest to the exchange. aka these liquidity providers or infinite liquidity fairies no longer have to identify themselves when posting new price improvements or posting new prices to the Nasdaq. This obviously encourages them to manipulate the price of AMC and other stocks even more, as they don't even have to identify themselves and expose who exactly is manipulating the prices. So it seems like the Nasdaq is even trying to encourage more manipulation. However, it does go to show the OCC, the DTCC and the SEC are worried about the squeeze, and they know that it's inevitable because they're trying to drum up additional cash to pay for the squeeze. And on top of that, Colliery has even provided a list of market makers using the exemption under the UK version of regulations to sell shares without locating them. The FCA, or Financial Conduct Authority, which is the UK's version of the SEC, has posted a list of market makers and authorised primary dealers using the exemption under the UK version of regulations on short selling and certain aspects of credit default swaps. So it says, according to this regulation on short selling and certain aspects of credit default swaps, the FCA shall publish and keep up to date on its website a list of market makers and authorised primary dealers who are using the exemption under the UK SSR. These companies are obviously eligible in the UK to sell shares and sell securities without first even having to locate the shares. This is obviously very similar to the bona fide market maker exemption that many of these market makers take advantage of in the US. But obviously in the US, we don't know exactly which companies and which market makers take advantage of this regulation. But in the UK, we actually have access to this list, and all of the typical names that you would expect are present on this list. We've got B of A Securities, we've got a number of different companies for Citadel Securities and Citadel Securities Europe, we've got Citibank and Citigroup, we've got Credit Suisse, we've got Deutsche, we've got Goldman Sachs and many others as well. Therefore, it's clear as day that Citadel Securities GCS Ireland and Citadel Securities Europe Limited are indeed allowed to take advantage of this regulation and sell shares without locating them. But I also wanted to touch on how close we are to this coming market crash and the coming AMC squeeze as well. Kohrs has tweeted saying the S&P 500 has gone from oversold to overbought in 3 trading days. He said the market can go a little higher, but I really see this rally as the last hurrah. Here's why. And he says before the great financial crisis, almost all economists were saying no recession and no hard landing in sight. A couple of months later, we were in the biggest financial crisis since 1929. These articles are from February 2007, predicting a soft landing, November 2007 saying the economy is healthy, February 2008 saying no recession is in sight, and even May 2008 saying a recession not so fast. Clearly, all of these economists, even in 2007 and even in late 2008, were saying there was no recession in sight and a soft landing was almost a guarantee. This is obviously exactly what the Fed is still saying right now to this very day, even though we're on the brink of the largest recession since 2008, maybe even larger. And he said it's highly likely we will get another negative GDP print in Q3 and Q4, given the impact the spike in mortgage rates is having on housing and consumer spending in general. The consumer sentiment for 2022 is at a record low, even lower than it was back in 2008 and 2011. And he said on top of that, the personal savings rate is also collapsing and the consumer is forced to use up all of their savings to afford basic necessities as prices have gone parabolic. On top of that, Wifey has tweeted saying these hedge funds are actually setting up for a major short squeeze. This screenshot says they're buying protection against a crash at a pace unlike anything the market has ever seen. The sudden and massive hedging activity of some of the market's largest traders is unsettling. This screenshot shows that options traders are paying record amounts of money for put protection. This is basically saying that call options on the S&P 500 right now are comparatively very cheap, but put options for the S&P 500 are at record highs and are very expensive. Clearly, puts are in very high demand right now for the S&P 500, and hedge funds are scrambling to buy up more and more put options. This is obviously because hedge funds are indeed long on the wider market, and they're trying to hedge for this coming crash by desperately buying call options as fast as they can. This obviously shows the crash is just around the corner if all of these hedge funds are desperately buying puts. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.